Hello everyone, and today we are going to talk about perpetual inventory system. What it is, how it works, how does it compare with periodic inventory system, and who actually uses it.
But before all of that, first we are going to start with the definition of merchandising firm. A merchandise firm is a type of business that runs with the purpose of purchasing finished product and then reselling the products to available customers. Suppose you are the owner of a local sari-sari store. First and foremost, you lend out cash to purchase goods from your local supplier. In this case, your local mall or grocery store, which you will then sell the purchased goods to your customer for the reason that you will earn revenue. Those revenue could be either cash, which is a liquid asset, and account receivable if the customer purchased goods from you is on credit or on account. And that is the cycle and definition of a merchandising firm.
And now let us proceed to the main topic.
What is a perpetual inventory system?
A perpetual inventory system is a program that continuously estimates your inventory based on your electronic records, not the physical inventory. This system starts with a baseline from a physical count and updates based on purchases made in and shipments made out.
And how does it work? The first step is whenever a product is sold, the inventory management system attached to the point of sale system immediately applies the debit to the main inventory across all sales channels. Barcodes or RFID scanners make this process quick and easy. Suppose you are selling t-shirts at a price of 50 pesos per unit and a customer purchases 5 units of t-shirts which cost the customer 250 pesos. The point of sale system will automatically trigger 2 accounting journal entries on your income statement and another 2 on your balance sheet. On your income statement, the amount of money the customer pays for the items, in this case, 250 pesos, is recorded as a credit to revenue. And on your balance sheet, the same amount is logged as a debit to accounts, receivable or cash, depending on the form of payment. Step 2. As transactions are being made and products are being sold and received through purchases, cost of goods sold will automatically update and be recalculated. Each sale and purchases of the company will automatically update the cost of goods sold. Unlike the periodic inventory system, you don't have to wait for an accounting period to end just to determine the value of cost of goods sold. But what is an accounting period? An accounting period is a period that is any time frame used for financial reporting. An accounting period or a reporting period is commonly 12 months. However, there may be different accounting periods for various business tasks. The third step is based on historical data. A perpetual inventory system will automatically update reorder points as sales increases or decreases to keep an optimal level of inventory at all times. For example, it is the December of 2022 and you are selling special limited edition t-shirts at the last month of the last quarter, and for the last 4 years, sales has always risen at the fourth quarter. The perpetual inventory system will then based on that historical data and increase your order threshold at the end of the last quarter, which is the December of each year. Because of this process, problems such as stockouts will most likely be deterred. The fourth step is whenever an item or an SKU hits its reorder point, the system generates a new purchase order and sends it to your supplier with no human intervention. For example, as you predicted, sales of limited edition t-shirts you produce will increase in quarter 4. As soon as the amount of the inventory left hits the reorder point, your perpetual inventory system will automatically order another batch of t-shirts. Suppose the reorder point is at 40 units. As soon as the inventory count hits that point, the perpetual inventory system will automatically order, let's say, 800 units. Your perpetual inventory system will order another 800 units of t-shirts at 8 pesos a piece and send it to your supplier. This purchase transaction will trigger another journal entry, but this time it's only on your balance sheet. In this example, a total of 6,400 pesos should be recorded as a debit to your inventory, and the same amount should be a credit to either cash or accounts payable. The final step is when inventory is sent to your warehouse. A warehouse employee will scan the product using a warehouse management software, so they appear in your inventory management dashboard and make them available for purchase on all or selected sales channels. Suppose the 800 units you ordered arrive at your warehouse. An employee then scans the product to check the quality and check for defects. Each product will be scanned and then will be moved to your warehouse storage as soon as all the products is scanned. Your inventory should go up by 800. Inventory calculation. To calculate for our inventory, first we must determine how much is our opening inventory is. To find the amount of our opening inventory, we only need to find the last period's closing inventory, and that would be our opening inventory. In this case, the closing inventory of the last period, which is September, will be our opening inventory this period, which is October. Suppose your closing inventory from the last accounting period is 500 pesos worth of inventory. You are selling pencils at a cost of 5 pesos per unit. This means that you have at least 100 units of pencils as your closing inventory. For the new accounting period, you purchase additions amounting 5,000 pesos worth of inventory, which is the total of 1,000 units multiplied by 5 pesos per piece. In periodic inventory system, this would be logged as purchases instead of inventory. For this transaction, we would debit additions for 5,000 pesos and the same amount would be credited to either cash or accounts payable depending on the transaction. The total of opening inventory and our additions would then be our cost of goods available for sale, which would then be our 5,500 pesos worth of inventory.
At any given time, our cost of goods sold will be updated since we are using perpetual inventory system.
Suppose you have sold 900 units for 10 apiece on October, totaling into 9,000 pesos worth of inventory. Before we proceed, note that unlike perpetual inventory system, the periodic inventory system doesn't recognize cost of goods sold immediately, only the revenue as sales take place. In the perpetual inventory system, this transaction would be recorded through debiting your cash or accounts receivable for 9,000 pesos. The same amount would be the credit for revenue, which is 9,000 pesos. But how did we get 9,000 pesos? Well, it is the total of 900 units sold for 10 pesos per unit. 900 times 10 would be 9,000. And now for our cost of goods sold. The total of cost of goods sold would be the cost to make the unit sold. Those costs includes raw materials that makes the product. In this case, pencil. Suppose the cost to produce per unit is 5 pesos. We multiply this by 900 units sold to customers. The total of this would be our cost of goods sold, which is 4,500. And finally, after getting the cost of goods sold, we now proceed to determine our closing inventory. And to get our closing inventory, we only need to subtract our cost of goods sold to cost of goods available for sale, which would then be 1,000 pesos. And that is our closing inventory.
But how does perpetual inventory system compare to periodic inventory system?
Periodic and perpetual inventory systems are two different inventory tracking methods that e-commerce businesses use to track and monitor stock goods. The perpetual inventory system is more advanced and used more often than the periodic system. A perpetual inventory control system tracks inventory in real time and centralizes inventory data. Inventory data is available to all parts of the system to forecast sales trends, calculate reorder points, and source items that are currently out of stock.
But who actually uses perpetual inventory system?
You would often see perpetual inventory system being used in grocery stores. For example, typically use the perpetual inventory accounting method. This method would not be necessary for a field service business that sells very few items of inventory on a monthly basis while making the bulk of its income from services.
That is all. Thank you for watching.